Hey everyone, welcome to today's explainer. As an investment analyst, there is literally nothing I love more than taking a company, completely stripping it down to the studs, and looking at the raw fundamentals. Today, we're throwing Arbor Realty Trust, ticker symbol ABR, into the ultimate valuation gauntlet. We're not just skimming the headlines here. We're going to apply the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, plus we'll run some modern discounted cash flow and alternative models. By the end of this, we're going to have a totally comprehensive, data-driven view of ABR's true intrinsic value. To get us there, we'll start with a quick snapshot of the company, view it through the Buffett and Lynch lenses, run the Graham math, do a DCF analysis, check some alternative models, and then bring it all together for our final verdict. Let's get right into it. All right, Section 1. Let's lay out the baseline facts for our protagonist today, Arbor Realty Trust. So ABR is a nationwide real estate investment trust, or REIT, and a direct lender focused on multifamily and commercial real estate. But man, the market has been a roller coaster for them lately. It's been trading somewhere between $5.31 and $7.24, facing some really stiff headwinds. Just look at Q1 2026. GAAP net income was a mere $0.6 million. They also just slashed their quarterly dividend down to 17 cents, though crazily enough, that still leaves them with a massive 12.8% annualized yield. Add in a heavy debt-to-equity ratio of 2.71 and nearly 24% of the float being sold short, yeah, it's a very volatile setup. Which brings us to the million-dollar question for this explainer. With that astronomical yield and a beaten-down stock price, are we looking at a hidden deep value gem? Or is this just a classic, dangerous yield trap waiting to snap shut on unsuspecting investors? Let's dig in and find out. Moving on to Section 2, we are kicking off the qualitative valuation with two absolute titans of investing, Warren Buffett and Peter Lynch. First up, the Oracle of Omaha. Warren Buffett demands two main things, a wide economic moat and super consistent owner earnings. Now, surprisingly, ABR actually has a pretty solid moat. They've got a $36.3 billion servicing portfolio as the top Fannie Mae and Freddie Mac agency lender. That's real, tangible value right there. But Buffett would definitely pump the brakes when he sees their financials. Their return on equity is hovering around 8.49%, and that 2.71 debt-to-equity ratio, that is a lot of leverage. Plus, management themselves admit that non-performing legacy assets are currently a tremendous drag on earnings. Because of that mountain of debt and unpredictable earnings, Buffett would probably stamp this as an avoid, or at the very best, a very cautious hold. Now let's pivot to Peter Lynch. The first step in Lynch's playbook is categorizing the stock. Looking at the data, ABR definitely falls into the turnaround or cyclical bucket. Why? Because right now, under CEO Ivan Kaufman, the entire game plan is intensely focused on untangling delinquent legacy assets and waiting out the current interest rate storm before they can safely redeploy capital. But when we run ABR through Lynch's actual checklist, yikes, a few red flags pop up. Lynch is famously a fan of rock-solid balance sheets, heavy insider buying, and low institutional ownership, which usually means Wall Street is snoozing on the stock. ABR pretty much misses the mark on all of these. The balance sheet is heavily leveraged, institutional ownership is actually super high at over 57%. And instead of insiders buying, we recently saw an insider unload 7,685 shares. Add in the fact that it's really tough to calculate a positive price to earnings to growth, or PEG ratio right now, because EPS is shrinking. And Lynch would almost certainly call this a strict wait-and-see situation until the turnaround actually shows up in the earnings reports. All right, Section 3. Let's switch gears from the qualitative to the hard, cold math with the godfather of value investing, Benjamin Graham. Graham has a super strict defensive investor checklist he runs through before he even considers looking at the stock price. Now, ABR does pass the size test with a market cap over $1 billion, but it totally fails the earnings stability test, having just missed Q1 adjusted EPS estimates by almost 39%. It also fails the uninterrupted dividend record test since they just slashed that payout down to 17 cents. So even though the current PE of 13.60 is relatively moderate, Graham would be incredibly cautious here. Still, as analysts, we have to run the actual intrinsic value formula to see what the math says. So let's crunch the numbers. Graham's famous formula is the square root of 22.5, multiplied by the estimated EPS of 38 cents, multiplied by the $14.77 book value per share. And what do we get? An intrinsic value of $11.24. Now, considering the stock has been trading in the $5 to $7 range, the math alone screams that there's a massive margin of safety here. But remember, because it failed that initial defensive checklist, Graham would heavily caveat this, warning that this deep discount comes with a ton of operational risk. Section 4. Discounted Cash Flow Analysis. Let's drag ABR into the modern era with some DCF modeling. Just to quickly demystify this for a second, a DCF basically tries to figure out the present value of all the future cash a company is going to generate. We project ABR's free cash flows out over several years, figure out a terminal value using a perpetual growth rate, and then discount all that future cash back to today's dollars using the weighted average cost of capital, or WACC. When we run the numbers, it's wild how sensitive this company's fair value is to interest rates. Because ABR's cash flows are all jammed up right now by those non-performing loans, we run a sensitivity matrix. If we assume a standard 10% WACC and a 2% terminal growth rate, which lines up with long-term industry averages, the math shows that the fair value swings drastically just based on the cost of debt. Even management pointed out that higher rates are prolonging the cleanup of their bad assets. If WAC ticks up just a little bit because of rate volatility, the DCF fair value absolutely plummets. Honestly, this is a model that requires extremely cautious assumptions right now. On to Section 5, Alternative Valuation Models. Since ABR is a real estate investment trust, we absolutely have to look at models tailored specifically for yield-heavy assets. First up is the dividend discount model, which values a stock based entirely on its expected future dividend payments. If we use that new 68-cent annualized dividend, the model might trick you into thinking there's immediate value here. But there's a glaring neon red flag. Market beat data puts their dividend payout ratio at an astronomical 174.36%. Let that sink in. They are paying out significantly more in dividends than they are actually bringing in as net income. That practically screams that the current payout could be a massive yield trap and totally unsustainable over the long haul, which pretty much shatters the reliability of this DDM model. Evaluating comparable multiples, we can see how ABR's price-to-earnings ratio of 13.60 measures up against its REIT peers, like Chimera Investment and Adamas Trust. Now, 13.60 on its own isn't wildly overvalued, but when you pair that with the fact that they just took a 74% year-over-year hit in Q1 net income compared to their competitors, yeah, it strongly suggests the market isn't pricing in future growth, it's pricing in current distress. And finally, Section 6, Final Synthesis and Verdict. We've run the gauntlet, now it's time to bring it all together. Synthesizing all these frameworks gives us a really clear picture. On the mathematical side, Graham's formula points to a really deep discount, valuing the stock at $11.24. But on the qualitative side, both Buffett and Lynch are waving yellow flags, strongly advising a wait-and-see approach because of the massive leverage and the messy turnaround. Meanwhile, our DCF proves the stock is hypersensitive to interest rates, and the dividend discount model is basically blaring alarm bells about a potential yield trap due to that 174% payout ratio. So where does that leave us? Ultimately, the data paints a very impartial, neutral picture. There is definitely undeniable upside here, especially if you look towards management's goals for 2027. If they can clean up the legacy debt and keep making smart moves, like how they recently redeemed their $787 million legacy CLO 17 to free up liquidity, there's a lot of room to run. But that leverage is a huge, very real risk in today's unpredictable rate environment. So filtering all this through the lenses of the investing legends, you have to ask yourself one question. Is the mathematical discount to Graham's intrinsic value actually worth the very real, very volatile qualitative risks currently sitting on ABR's balance sheet? It is the classic showdown between theoretical value and operational reality. Thank you so much for joining me for this explainer, and as always, keep doing your own rigorous analysis out there.